Well, greetings, everybody. Today, I'm very fortunate to have Nick Ward back on the channel. He's been on before, and you know him. And I thought it'd be very useful to talk about banking with him. Now, as my subscribers will know, I was on the Economic and Monetary Affairs Committee in Brussels for 5 years. And I have made many speeches about banking and the fragility of Western banking systems, um, all of which is very well and is very true. And it's as true today, if not more so, than when I made those speeches. But Nick is at the sharp end. He's right at the sharp end. So he's not dealing so much with strategic theory. He's dealing on a daily basis with actually what's going on at the coal face. And I think this is what we need to get the information on that. So I'm going to ask him to do that for us. Before I do that, I'm just going to remind everybody, for my subscribers, because I've banged on about this before, what you have to bear in mind when it comes to banking, and this has all happened since the Bank Charter Acts in the 1840s, that when you put your money into a bank, it then becomes the bank's. It's not yours anymore. It becomes the bank's. And they give you an account or a chit or a receipt or whatever you'd like to call it. And it's a promissory note. So in law, it's their money. And of course, since that time, on top of that has come regulation, which they can hide behind in order to stop or persuade you not to get your money back. And a lot of people don't fully understand that. And I'm going to hand over to Nick now to explain anecdotally sometimes about what's been going on, how it works, and what you might bump into when you decide to take your money off the table. If you're wise, get out of the banking system, get out of the cash system, and start doing something practical where you can. But some quite interesting stories, because obviously Nick shared with me over the last quarter, and indeed this has been going on for a couple of years. So Nick, thank you very much again for coming on. Tell us the tale, dear boy. Tell us the tale.
Well, thanks very much for having me on again, Godfrey. Always a pleasure. But to sum a long story short, we're basically in a dichotomy where if you leave your money in the bank, the best case scenario is you'll see it slowly eroded over time and lost to inflation. Worst case, the bank go under before that even happens, and you lose it all immediately. Now, what's key to how this is going to play out, and what most people don't even realize, is you're not protected at all by the so-called deposit protection limit of £85,000. I suppose that figure's it's like the emperor's new clothes. It looks convincing on the surface, but fundamentally it's completely invisible and it's based on nothing. And just to put it into perspective for people that don't know or haven't even looked into this, the latest figures published by the Financial Services Compensation Scheme themselves, the FSCS, as you probably all know them by, show they've now got 1.4 billion in reserves. You might think, oh, 1.4 billion, that sounds like quite a lot. That's covering a whopping 5.4 trillion in UK deposits. I've got the number here. That's roughly 0.026% of all deposits in our bank accounts that are protected. Or to put that another way, for everyone that's got £100,000 sat in their bank account, that's covered for £26. Now, this scheme, as you well know, I mean, you've stood up in the European Parliament and spoken about it many a time, Godfrey, but it's meant to protect you in the event of a Cypriot-style banking crisis, like we saw back in 2013, when the banks were forced to impose bail-ins, not bailouts, bail-ins, where they just stole people's money. But the truth is, in the UK, the scheme's only designed to handle the failure of one or two regional building societies or one small bank going under on its own. Nothing close to a nationwide or systemic failure in the system. So it's essentially gambling on the premise that everyone won't take their money out at the same time. So you can see by those figures, Godfrey, the FSCS, it's not real insurance at all. It's a risk assessment based on the assumption that everyone won't rush to withdraw their money all at the same time. And what the government are doing here is they're taking a risky bet. They're all too aware of it. They know exactly what's going on, but they present it as a safeguard to everyone. With you'll see on when you're opening a new bank account, you've got the little FSCS logo on there. But in reality, all of that, it's a marketing ploy. It's there to inspire confidence. That's it, nothing more. And if you want to look at the technicalities behind it, if deposits were truly fully insured, banks would obviously carry massive reserves to cover every penny. But by definition, that's impossible, because if those funds really existed in full reserve, they'd be sitting in the bank's vaults. So this FSCS scheme, it's a digital promise, a claim on money that doesn't even exist. It's not there, it's just promises. And those reserves they claim to hold, Godfrey, what bank do they hold them with? What bank does the bank hold them with? Well, it's impossible by design. So instead, that scheme, it's not backed by cash, it's actually backed by treasuries, IOUs, or government loans, which is just more debt upon debt upon debt. And that's exactly why so many of the wealthy individuals, not even wealthy, a lot of people, large institutions, they don't keep their money in savings in conventional banks. They own tangible assets like gold or property or other real world wealth, because they understand just how fragile the system really is, Godfrey. I mean, every single one of our high net worth clients that we deal with, they clear the decks. If it's capital they do not intend on using in the short term, they clear the decks. But at the same time, if you're a family office or an institution or whatever it is, they're not even allowed to legally keep their money in the bank, because they know the risk. The experts, the institutions all know the risk. They just will not communicate it to the public. And again, that's just because they realize how fragile this system really is. They've been playing it. Yeah, go on. Sorry, go on.
Now, just remembering, I expect you remember from your school days, quo ipsos custodiet custodes, who will guard the guardians.
Exactly.
Yes. Or it's a bit like two drunks propping themselves up together, really, isn't it? So that's the long and short of it. And of course, just picking up on something you said there, which of course we know to be factual, and certainly an old man like me knows to be doubly factual. That is, you don't often get a run on one bank. If a confidence goes in a bank, that everybody's queuing around the block outside their bank, because the thing, if that bank's going down, my bank might go down, and then you've got a queue, and then you've got to run on the bank, which of course we're not ready for. Plus, of course, there's the implication that, as always, I made this point in the Parliament on many occasions when I was on that committee 15 years ago. Of course, they will then get the taxpayer to bail people out. And the only way they're going to be able to do that is to print money. So the money that even if they managed to pay out those people in insurance, so-called insurance, it would be in such a degraded currency, it would be meaningless. And with digital currencies coming in, all they would do then is say, no, don't worry, it's digital now. And they can just type it on an electronic board and everybody will be paid out in meaningless electrical digital stuff.
You hit the nail on the head. Exactly that. Yeah. They call it socializing the losses, I believe, Godfrey, amongst everybody. So you don't really know that the losses are happening. The communism of losses, really, rather than just directly pilfering it out of everybody's bank accounts as they see fit. Either or, with they're damned if they do, with they're damned if they don't. But again, coming back to that deposit protection, to mention that, well, since the pound's inception, it's lost over 99% of its value. So the real purpose, if you want to look at it from a cynical point of view, the real purpose of this insurance isn't to protect your savings at all. It's to gradually erode the value of your currency while you don't notice, with a deliberate process of inflation. It's designed to make you feel secure while steadily stripping your purchasing power away and preventing you or discouraging you from moving it. And I suppose a poignant example of this is, Godfrey, let's say you earned the same wage for 60 years and you never took a pay rise. Just leave that aside, the pay rise, for 1 second. If you earned the same wage for 60 years, even with a tiny 2% inflation rate, and look, we're a good 5-10 times more than that at the moment, but even with a 2% inflation rate, you'd lose 69% of your lifetime earnings over that period as it starts to compound. And if you want to equate that to years of your life, that's 41 years the government have stolen from you, the banks have stolen from you. And that's why it's in their interest to guarantee you something like this. In reality, you're paying for that artificial security with the lowering in value of your savings. It's almost sadomasochistic. You couldn't make it up. And you're having to work harder and harder in order to save more and take on more risk just to keep ahead of it, all the while you're thinking, oh, but my money is safe. It's safe in the bank. And in doing so, that encourages you to further speculate in the market and borrow even more. And this is the very cycle that feeds the system's eventual collapse. It's economic gaslighting, Godfrey. That's the way I suppose I put it. They're gaslighting you when they tell you that it's safe. They know full well it's not, but it's how they subtly and nefariously steal your purchasing power through the back door while they kid you to believe that money's there. And again, another quote, I love the one from earlier, Godfrey, that I think it's famous German writer called von Goethe.
Oh, yes.
Yes. He said that none are more hopelessly enslaved than those who falsely believe they are free. And I cannot think of anything more apt to describe the current situation that we're in. Everybody thinks we're free. Oh, I've got a bank account here, one there, one there. I'll spread my 85,000 amongst all of them. They think they've got freedom, but they've got none at all. They're trapped in this invisible prison that they can't see while they're losing their money. And again, over in the pond, Godfrey, it's hardly much better. It's the FDIC over there. You probably know the stats on this one, but about 1.28% of deposits are supposedly in that scheme. It's a hell of a lot less than us, but still only 1.28%. And that's even below their own self-imposed legal minimum of 1.35%. So it's happening throughout the world. Nothing is insured. Nothing is safe. And again, you've seen this, as I know, I think you spoke to Lynette Zhang at one point, but there's been a video leaked on the other side of the pond from an FDIC meeting, so the American equivalent of ours. And they're discussing something that they call perception management, whatever that is, perception management. But they openly admit there's no professional need for the public to know the full truth of how the system operates, and that revealing too much of it could cause unintended consequences, basically. That they're even seen in this room laughing about it. It's on WikiLeaks, so you can get it there. But obviously, those unintended consequences that they're referring to are bank runs, of course. We all know exactly what they're talking about. And they say, look, clearly the public trusts the system more than we do. Ha, ha, ha. Okay, well, that's really good to know. But looking at just coming back to our present situation here for a minute, just running the numbers, doing a bit of fag packet maths, if you like. But if less than 1% of depositors in the UK now demanded their money out all at once, the whole house of cards would collapse. It just takes two banks, a building society to slip into trouble, and no one's insured. And of course, it just takes hundreds of thousands, maybe 1 million, 2 million people rushing to withdraw. And that slight wave is just going to turn into a cascade, a tidal wave of withdrawals, as you mentioned earlier, creating that snowball effect and triggering even more panic, even more runs, and perpetuating the problem and making it even worse than it already was.
I'm speaking to, funnily enough, you should mention Lynette Zhang. I'm speaking to her next Wednesday. So I'm doing a recording with her next week. So be good to get a perception from what's going across the pond, which of course we know to be the same thing, but probably with a slightly different angle. I don't know, but I'll be speaking to her. But of course, none of this is new, and you and I have discussed this before. That famous quote from Henry Ford, I think I'm right in saying it was 1926, when he said, if people understood how banking worked, they'd never put their money in a bank.
No.
But
I think there would be a revolution before the morning began or something along those lines.
That's right. Give us some of these, because I think something's manifesting itself here, because on top of the Bank Charter Act, which was a fundamental change in ownership of the money, de facto and de jure, we also have an interesting situation now. We have lots of regulation, bank regulation, which is actually written by banks to hide behind because they all piss in the same pot. What we have a situation here, do we not, where if they want to hang on to your money, they don't want to see it disappearing, that instead of they then suggest perhaps that you're being scammed, or you don't want to do this, or you don't want to take, what you want to do is take your money off the table and of course buy gold, or you buy silver or precious metals, or indeed whatever it happens to be. It's always a bad idea. And they stall. And I think you've had a number of these, and I have other people getting in touch with me saying this is happening more and more. And we used to think, I know you and I have chatted about this on many occasions, we used to think it was sort of one particular bank being the worst, and Nationwide was always the worst bank. And if anybody listening to this, if you've got money in Nationwide, please take it out, switch bank, because they really are bad. But it's not just one bank. I mean, I'm hearing horror stories from all sorts of lists of banks. You can't actually get out of it by changing your bank, although Nationwide is the worst.
Absolutely. There's no consistency with it at all. They change their minds like the wind. 1 minute you're getting £1 million in from one bank, and then the next day they decide you've only got a cap of 10,000. So it's dependent. My guess would be on their liquidity ratios, how many people have taken out on that day, how many other deposits have they had. So they use very clever computer algorithms to try and calculate that. But just coming back to what you said, Godfrey, absolutely. When you deposit your money in the bank becomes the legal owner of those funds. And once they own it, they can spend, lend, or use it as they please without any of your direct control. So fractional reserve banking, which is obviously what it comes back to, just means that the banks only hold a tiny little portion of customer deposits in reserve. And these they don't just have to be cash, by the way. As we said earlier, they can be a combination of cash or government bonds held with the central bank, so the Bank of England. But what's really alarming, and again, to mention the regulations, the introduction of the regulations, Godfrey, is there's no actual fixed percentage the banks have to keep. Nothing. If you look at the Basel guidelines, the banks only have to maintain certain liquidity coverage, which ties into this. They call it liquidity coverage ratios, or LCRs, which ensure that they have enough high quality liquid assets, which is just debt, it's not even cash, to sustain operations for at least 30 days. That's it. No longer than 30 days. Now, we've seen crisis play out in the past, Godfrey. We know on average, they go on for years, not just days. So they've got to keep money there for a month during a crisis. That's it. So the precise reserve requirement, but from these regulations, it's very, very tricky to figure out, and deliberately so. I think that it's very opaque. But it's a much smaller percentage than most might expect. Generally, from what we can calculate, it's between 1% to 3%. The rest of those deposits are just used for loans, investments, just supporting the bank's ongoing operations and generating more profits for them. So the majority of that money sat there is just a digital entry on a computer screen. Promises of value.
To pick up on that, actually, which I think is interesting. Another thing that people wouldn't necessarily know, and how could they if it's not their field? I mean, if you're a surgeon or a barrister or a joiner or a chippy or something, you wouldn't know about this, because it's only geeks like us that understand this kind of thing. That's what we do for a living. I can't put a shelf up. I'm hopeless. But it's each to their own, isn't it? But what was interesting, the bank that went down in California, relatively recently, had a very high proportion of what is a tier one asset, which of course was United States government debt, T-bills and bonds and stuff, which you would imagine, would you not, if you had that kind of reserve, that would be pretty well rock solid. But of course, what isn't generally understood is that interest rates go up, and they've been going up since COVID, and they wouldn't they? Your capital value of your bond goes down. And that is something which I remember when I was lecturing at certain universities as a guest lecturer, left a lot of people scratching their head. But it's actually quite easy, because if you bought a bond at 5% coupon yesterday, and interest rates go to 6%, that bond isn't as attractive as it used to be, so the capital value goes down. It's not difficult, but it means it's very difficult to keep capital or keep back. And of course, the other thing is, one said, oh, well, tier one gold is a tier one asset. But you see, commercial banks don't have gold reserves. Only central banks are interested in gold reserves, and not even some of them. So if your money's in a bank, it's very difficult to avoid potential disaster. So I think that the takeaway from this, the big takeaway from this little a conversation we're having is, you don't want in a bank any more than to pay your monthly bills and make life easy for you, because you need some money in the bank, but you do not need any more than a few pounds in the bank in order to meet your monthly bills. And that's it, because you might argue, it's actually, unless you live in a really high risk crime area, it's safer under your mattress if it's in cash.
Absolutely. I think Silicon Valley Bank, the bond market collapsed.
Silicon Valley, I couldn't remember the name.
First Republic, obviously Credit Suisse, that knocked over, had a domino effect over to Europe. That was only a couple of years ago. That's the tip of the iceberg. The economic situation now is a hell of a lot worse than it was back then. They've got even less in deposits. So, in reserves. But when they're caught with their pants down, the lie's exposed, and you end up with a bank run because they can't cover the withdrawals. So you've just got a pile of IOUs. That's all it is. And that's coming back to what you were saying. That's why they're really playing hardball with everybody. They do not want you taking your money out, come what may, and they will kick and scream and put every bureaucratic barrier in place. Godfrey, I've had clients have their accounts suspended with a couple of providers, just trying to get 10 or 20 grand out. And these are their main checking accounts that they've got all their direct debits going through and everything else. 3 months later, nothing from the bank, they can't get it out. It's disgraceful. I'd certainly encourage people not just to consider spacing it around, because as we know, it's not insured at all. Get it into something physical and tangible. And that's what, like I said, so many of our high net worth clients that we're dealing with do. They do this for a living. They've been through these boom and bust cycles. They know exactly how it works. They're not leaving money in the bank. That's for everybody else. That's for the hoi polloi, the masses, your average man on the Clapham omnibus. They put their money into a physical asset, real money, which is gold. It's a physical bank account. Whenever they do need to cash out of it, they can. And it's probably far more liquid than most banks at the moment. When the market crashes, gold goes up. Every other asset is on a fire sale. They hoover those up, and then the whole process starts again. And that's why the rich are getting richer and richer and richer, and the poor are getting poorer. And we've got such a social divide at the moment. It's because of how this fiat system is set up. It's designed to make you fail. It's designed to keep you on the hamster wheel for as long as they possibly can. And all the while, they'll preach inflation's only at 2% Well, why are they hoarding gold then? Why are they buying it? It's hypocrisy, total hypocrisy and gaslighting. I just wish more people could see it. But when you go and ask for 200,000, let's say, for example, they just type into your account 200,000. That's all they do. They don't mint any coins. They don't print any money. They don't move any precious metals anywhere. They just create it out of thin air as debt. It's all designed to keep you enslaved and paying interest, which obviously doesn't even exist either. It's a control mechanism. And obviously they don't play by the same game. And you're absolutely right. If you're not planning on using cash for the next 2, 3, 4, 5 years plus, clear those decks, get it out into physical gold. Obviously not the entire lot, of course. You need liquidity. You need to cover your short-term emergencies, your bills and everything else. But it's just for those that have been sat on money for years. They don't realize how much they've actually lost. And the government are just point blank lying about the real inflation rate. I mean,
I need to make I think I'll make an observation, which I don't often make about this particular thing, although it is the elephant in the room. We've already heard the mutterings from this government about a wealth tax, and a wealth tax is something, of course, that is loved by governments and has been for some time. A wealth tax is already, and I will say, I'm not going to go into any much detail about this. If the government can find it, if it's easy for the government to find it, they will steal it. Because they can't help themselves. We live in a kleptocracy.
Yeah,
it's a kleptocracy in which we live.
They believe everything is owned by them, and you simply rent it from them in your lifetime. Exactly. When you have the luxury of dying, Godfrey, you pass it back to the state.
They'll take it anyway. Yeah.
Yeah.
So exactly. That's something that watching this, because I often get a lot of people come onto my website and say, basically, you know, they say, oh, well, you know, it's all very well this, that, and the other, but, you know, I can't do this and I can't do that. But I think you need to bear in mind that the advice that we give, or the conversations that we have here, are for people who have worked really, let's be frank, quite hard all their lives, and they've got a little bit stashed away because they've been prudent and they've done their best. And you don't want that in the shop window, either when you die or whether there's a wealth tax or whatever it is, because although there is an audit trail, that audit trail gets thinner and thinner and thinner the longer you go. And so that's just something for people watching, saying, you know, what am I going to do? I've got kids, I've got grandchildren, so on and so forth. Just consider that. That isn't financial advice. That's not investment advice, because gold isn't an investment. Gold is a preservation of wealth. But don't be caught with your trousers down. If you're watching this and you're perhaps, I don't know, maybe my age, but younger than me, perhaps, just be a little bit canny about these things, because the powers now that the government have to take from you, and then it can go to review, and then you can appeal and all the rest of it. But possession is 9/10 of the law. And so this is why you need to be particularly careful. So, and if you speak to Nick, and the website, my website now is the biggest, I gather, I've been told it's been the most comprehensive in the country. It's independent. But you will find access to Nick on there. If you can look him up on there, and it'll all be there after this, as it always is with Nick, because everybody's different. You might have a personal thing to talk about. These things are personal. Everybody's circumstances are quite different. So if you want to talk it through, you can either email me on my website or get direct in touch with Nick or anybody on my website that's there. They wouldn't be on my website if I wasn't comfortable that they were reputable dealers and all the rest of it. Nick comes on because Nick is a little bit more experienced than most of the dealers you'll probably speak to, and if you've got a dealer, that's fine. But I just mention that caveat because I think it's very well worth doing. What else have you got to tell us, Nick? What else do you think is? Tell us a little bit about custody. There'll be people who I'm a big believer in taking delivery if you can, but it's not always possible. If you've got, say, £50,000 or £100,000 worth you've decided to take out of the bank and put into gold, or out of an investment which you think is probably overpriced these days, it could be equities or whatever it is. Tell us about the custodial situation. Obviously, we don't want to give it back to a bank and their vaults, because a lot of them are owned by the government. Tell us a little. We don't often cover that. Tell us about the
state of it. Yeah, you don't want to keep it on the bank's balance sheet either and custody it with them. You need to do it take delivery of it, or you can vault it with us in London or Zurich. It's got to be fully allocated, fully segregated. So you've got your own vault, and it's in your name and your name entirely. But look, some people will take delivery of millions of pounds worth. Godfrey had a guy take delivery of a couple of million only weeks back. He buried it in his garden and planted a tree on top of it. At the same time, other people don't feel comfortable having 10 or 20,000 pounds in their possession. But I'd say on average, we've run the numbers again, about 80% of people that do 20,000 or above will usually custody it and get it in a vault. But there's no rhyme or reason to it, really. I suppose it's like saying how long's a piece of string. Everybody wants to get their money out the bank. It doesn't matter how much or how little you have. And yeah, to reiterate your point as well, Godfrey, from earlier, people think they have all the time in the world, but they don't. The life raft that you've got, the exit hatch to get onto that, is shrinking and shrinking and shrinking under this this bunch that are in charge at the moment. Before you know it, you won't be able to get your money out and buy anything at all. Look at all the terms and conditions in people's bank accounts when you open them up now. I know you've touched upon this before, Godfrey, but they accommodate now for bail-ins, all of them. So there's no smoke without fire. They are clearly up to something now. So that's why you've got to get it into physical money that actually exists, that's in your possession, regardless of whether you've taken delivery or you want to set up a vault with us. Just get it out the system as long as you don't need it in the short term, because something's brewing. And even if the banks don't crash in the next week, the next month, the next year, it's still inflating away. If you could see your money ticking down by 1.5% every month in the bank, there would be a mass exodus. Everybody would leave immediately. But because they don't see it, they don't think it's happening. I just want to make sure that people are aware this is the silent killer. It's set up to make you fail. They know exactly what you're doing. Just be proactive with it and take a bit of action, because there's going to come a point where the whole system, this debt bubble, is going to implode. And people will be left with contracts that aren't worth the paper they're written on.
I'm getting, I've been seeing, just I've been dipping in, we off a little bit off subject, off topic here, modern monetary theory, which has been quite interesting. There's some very, very plausible people out there with their websites and with their videos on modern monetary theory, explaining how debt doesn't matter. And because we're only lending it to, we're printing it, and then we're lending it to the Fed, or we're lending it to the Bank of England. I'll just make this point now for everyone. There are no circumstances where debt doesn't matter. Debt does matter. And if the American and the Fed people say over there, they say, oh, we can't go bankrupt, we print the money, we can't go bankrupt, so the United States can't go bankrupt. Well, you know, it depends your definition of bankrupt. They say, well, just a minute, your money, we haven't gone bankrupt. We've still got the money in the Reserve or the Bank of England or whatever it happens to be. It's just worthless, like the Deutschmark in the early 1920s, where you were papering walls. You had wheelbarrows with the stuff. So you're not technically bankrupt, perhaps, but the stuff that you're doing is worthless. And I can't help but believe those days are coming again. In fact, the Trump administration actually want to devalue the dollar to make their exports more effective. And yet, if I may just touch on that for anybody who's interested in that, if you're an old geezer like me, you'll remember when German cars suddenly started to take over in the 1970s, because they were very well made indeed. Mercedes and BMW and Volkswagen, they were well made. And very reliable, but they weren't cheap because the Deutschmark was cheaper. The Deutschmark was going up, so it's a fool's errand if you think by degrading your currency that somehow it's going to make your goods more saleable, because all you're doing is degrading the salaries that your workforce gets, and your imports become more expensive. So don't fall for this MMT, they call it, modern monetary theory. If anybody, should they knock on your door and come and talk about it one day, modern theory, check the spoons before they go. Check the spoons before they go, because they're crooks.
But it's a race to the bottom, isn't it? Every time one devalues, the other does, the other does, the other does, until everyone's left with nothing. It's happened every time throughout human history. Every fiat currency goes to zero. 740 of them now, Godfrey. Yeah.
And I'll bore everybody to death. I'll say it again. A sovereign, a 1900 sovereign would buy you bed and breakfast in either Berlin or Paris or London or New York. And that sovereign will buy you that today, because a sovereign, which used to be basically a pound coin in the Edwardian era, and Edward VII's face on it, was broadly equivalent to £1 then, and a pint of beer was twopence, and then now it will buy you the same because a sovereign's worth about 600 quid. And in 100 years' time, a sovereign will buy you bed and breakfast in good. It's not an investment, it's a preservation of wealth. And if you take nothing else away from this little chat between Nick and I, gold is a preservation of wealth. So if you're going to, don't email me and say, oh, my house has gone up by this, that, and the other, or my investment portfolio of equities has gone up over the 20 years, blah, blah, blah. All of that may be true, and I'm not disputing that. The thing is, preservation. If you've made it in either property or equities, whatever, if you want to preserve it, there really is only one route. And of course, as we will always suggest, it needs to be, if it's coin of the realm, you're avoiding VAT and you're avoiding capital gains tax. And we don't all together know quite how long that's going to last either.
Absolutely, Godfrey. Yeah. I don't think people realize as well how little gold there is left. You can, there's no end to how much money they can print. It will just go on into infinity. It's so difficult to actually understand. The human mind cannot comprehend billions, let alone trillions. So if you, I found this really, really interesting, a statistic the other day. If you look at the 5.4 trillion in the UK banking system, that number's so vast, it's incomprehensible. But if you were to convert that into seconds, a billion seconds is about 32 years. But 5.4 trillion, which is just the UK, that's just us, that's over 172,800 years. That's the scale of the Ponzi scheme we're living in right now in the UK. About £180,000 worth of debt for everybody. Crazy.
It's astonishing, isn't it? Of course, when you deal, if you deal with, if you're looking at those space programs and that kind of thing, they deal in light years. Yeah. And of course, they talk about something is 70 light years away if they found a new planet or new star or something. And of course, I'm not going to pretend that I'm any different to anybody else. It's beyond human imagination because we're not, our brains aren't structured for it. And it's like infinity. If you don't mind just a finite infinity. I mean, if you think about infinity, your head will fall off because it's just not what we do. It's a fifth dimension which we can't think in. Yeah. Any more than our dogs, when you've got a lead wrapped round a terrier, will understand that it will wrap itself around the leg of the table because it can't go that way round because it's on a lead. And I know about these things because I've got to.
Yeah, absolutely. Same with compound interest, isn't it, Godfrey? It was, I don't know. There's a debate as to whether Einstein actually said it, but said it's the eighth wonder of the world. You just cannot contemplate how something will grow or decrease as it compounds over time, and that's what they rely on with inflation. It's 5% on 6%, 8% on that 6%, then 9% on the 8%, and it just gets faster and faster and faster as time goes on. And people think, why is everything going up in value? Oh, it must be the greedy corporations, price gouging and everything else. No, it's not. It's the value of the money in your bank going to nothing.
Money going up. Absolutely. Exactly. And the funny thing is, the numbers that they tell you, I've often advocated this, and at the risk of boring everybody to death by repeating myself, but the Chancellor of the Exchequer should always be a Yorkshire housewife. Because she is the only one that really understands that money is being degraded. And if when you come out up here where I live, trying to suggest that inflation last year was 2% to a Yorkshire, a working class, perhaps a working class Yorkshire housewife, well, don't come up here because you'll get a smack in the mouth.
Yeah, well, these people, they don't really need to manage their budgets, do they, Godfrey? Because everything's on expenses anyway. They're living in ivory towers. And they've got no idea,
like their pensions, the public sector, index linked. Yeah, they don't bill the draft because they're not part of this game. If you're in the public sector, you're not part of this. It's only ordinary Joes like us and our neighbours who are in the game. Well, not my neighbours. They all come out of the public sector. Anyway, enough of that. We mustn't digress.
Absolutely.
I think that was very useful. And we're going to come back, everybody. If you found it, please do tell us if you find it useful, and if there's something you want discussed. Because between us, we do know a little bit about this particular subject. Notwithstanding, neither of us can put a shelf up, but we do know about this, and we are contemplating explaining the background to the Bank of England next time we come on in a few weeks' time, maybe. Which I think you'll find very interesting. It's a very interesting concept, and we're going to dig into that a little bit. If you enjoy these little clips of half an hour or so, I think I'm certainly looking forward to that. And I think we probably discovered one or two little things that I didn't even know. So there we are. Anything else you'd like to add there, dear boy?
No, that's it. That's it from me. It's just if people want to do the digging on the numbers, it's all publicly available. They're pretty shady with it. It's hard to find, but you can get it. Just realize that it's not covered for 85,000. So don't let them delude you into thinking it.
And I'll just add a caveat before we sign off on that one. If your bank clerk tells you can't have the money in your account back to do something else with it, you've got to be tough. Don't burst into tears, whimper, and run away, because he's spivving you. And call him out. Call him out.
Absolutely.
Okay, well, thanks again, Nick, and thanks everybody for watching. And speak again soon.
Yep, look forward to it, Godfrey. Take care. Bye.
Toodaloo. As most of you know, my work is very heavily independently research-based. And I get my information from all over the world. It would help if you press the subscribe button and the little bell next to it, because the more subscribers I have, the more likely it is that international independent research institutes will share their material with me. It's most helpful, and then of course I automatically share it with you. So surprise, won't cost you anything. Thank you very much.